Hey there, welcome back to yet another video. In today's video, I want to talk about the Fed decision to pause interest rate hikes and the effect of this on the U.S. economy. The Fed Chairman Powell announced this in his recent meeting with the press.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
You see, it is crucial for the Federal Reserve to prioritize its dual mandate of promoting maximum employment and stable prices. The impact of high inflation on people's lives cannot be ignored, and it is essential to address it by working towards the goal of 2% inflation. Price stability is the foundation for a thriving economy and ensures long-term benefits for all individuals in the labor market. So, let's find out how maintaining price stability is the secret sauce for a booming economy that puts smiles on everyone's faces in the job market. Let's get this financial fiesta started.
I give you my word. He's gonna fix the economy.
So, without further ado, let's dive headfirst into the three main topics that will leave your financial senses tingling with excitement. Get ready to ride the high-flying roller coaster of economic amusement. 1. Monetary policy. Get ready to dive into the Federal Reserve's cautious approach to interest rates. We'll explore why they hit the pause button and how it affects borrowing, investments, and your spending power. 2. Financial markets. Buckle up, because we're taking a wild ride through the world of stocks, bonds, and foreign exchange. Discover how investors react to the news and the roller coaster ride it creates for asset prices and market sentiment. 3. Economic outlook. It's time to put on our economic glasses and see the big picture. We'll analyze the factors behind the decision, like inflation and job markets, and uncover how this pause may impact employment, prices, and business growth.
Let's go!
Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
You see, last year, the economy hit the brakes, but fear not. We're now on the road to modest expansion. Consumers are splurging, but the housing sector could use a little pick-me-up due to those pesky mortgage rates. Businesses are feeling the pinch too, thanks to higher interest rates and slower output growth. Now hold on to your wallets, because here come the numbers. GDP growth projections for this year and next are a bit below the norm. On the bright side, the job market is hustling. Strong job gains and a low unemployment rate show that things are moving in the right direction. But don't be fooled. The labor market seesaw is leveling out with more people joining the workforce and wage growth easing up. As for inflation, it's been misbehaving, but there's hope. The Federal Reserve expects it to behave and gradually calm down. They also predict a slight uptick in the unemployment rate. And hey, don't fret about inflation expectations. Surveys of households, businesses, and forecasters say they're keeping their cool. So, there you have it. The U.S. economy is on the move, with a few bumps along the way. Buckle up and get ready for this wild financial ride.
Seatbelts, everyone!
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
The Federal Reserve is here to save the day from high inflation. They're like superheroes protecting our purchasing power, especially for those struggling with rising costs. Their mission: bring inflation down to 2%. But remember, patience is their superpower. They're monitoring the impact of their monetary policy on different sectors, despite the twists and turns of tight credit conditions. Don't fret, they've got it under control. The committee is making conscious decisions, considering all factors. There are financial heroes, ready to tackle whatever comes their way. In their latest meeting, they decided to keep interest rates steady and tidy up their securities holdings. Sure, there's talk of rate hikes down the road, but they're taking a breather to see how things unfold. Those rate projections? They're more flexible than a contortionist. The Fed will adjust them based on the economic landscape. They're all about maximum employment and price stability, staying agile with their choices. So, buckle up, folks. The Federal Reserve is on a monetary adventure, closely watching the numbers and making moves accordingly. Let's see where their superpowers take us next.
We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions.
Alrighty, listen up, because I got some Fed-tastic news for you. The Federal Reserve is on a mission to tackle inflation like a marathon runner chasing a donut on a stick. They're committed, determined, and ready to break a sweat to bring prices back down to their 2% goal. But hey, they know it won't be all rainbows and unicorns. It might mean a bit of slower growth and a softer job market. But hey, no pain, no gain, right? Now, here's the scoop on today's decision. Drum roll, please. The Fed hit the snooze button on interest rates, keeping things steady for now. They're taking a breather, assessing all the juicy information before making any bold moves. Think of it like driving a car. Sometimes you've got to take a pit stop and check the map before deciding on the speed. And let me tell you, the data came in hotter than a summer barbecue. Higher GDP and inflation estimates are like a firecracker that needs some taming. So the Fed's playing it smart, aiming for a gradual process to cool things down. It's like letting the air out of a balloon, nice and slow. We're in for a steady ride. Folks, the Fed's keeping a close eye on core PCE inflation, like tight pants after Thanksgiving. They're monitoring the labor market for signs of change. Rate hikes are adjusted like navigating through traffic, finding the sweet spot. The Fed is determined to tackle inflation and keep the economy running smoothly. News spreads fast, impacting spending, while broader demand moves slower. Experts disagree on timing. Ever wondered what signs the Federal Reserve keeps an eye on to figure out if their game plan for monetary policy is actually doing the trick in keeping inflation under control? Well, let's find out together. What indicators do they use to gauge the effectiveness of their approach?
Long it takes. So, and that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
When tackling inflation, take one step at a time. The Federal Reserve is on a mission to bring those prices down. From core services to housing prices and even wacky used car fluctuations, they've got it covered. But wait, there's more. Wage inflation is the secret sauce for reducing non-housing service inflation. Get ready for some serious labor market impact. But how did they do it? The Fed's got your back with guidance and adjustable reactions. As I have said, they're like superheroes with data-powered capes. And speaking of powers, they're keeping a close eye on the Treasury's borrowing plans and making sure their balance sheet adjustment process is as smooth as butter. No worries though, reserves won't be running out anytime soon. Hold on tight, folks, because rate cuts aren't on the menu this year. But fear not, the Fed is always watching and ready to take the necessary actions. Housing and rents? Oh yeah, they're major players in the inflation game. The Fed is laser-focused on stabilizing those costs to keep the inflation dragon at bay. Now let's talk about risks. The Fed is like a guardian angel for financial stability. They're on the lookout for systemic risks, monitoring credit conditions, and making rate-setting decisions with the utmost care. It's a balancing act, but they got it down to a science. So there you have it, folks. The Fed's got the inflation-fighting team assembled, and they're tackling it head-on. From housing to wages, they're on the case. Get ready for a smooth ride, because the Fed's got your back, keeping the economy in check. But here's the burning question. Are you ready to join the inflation-fighting squad?
I am ready, baby!
What do you think about this topic? Share your thoughts in the comments section below. Don't forget to like, share, and subscribe to this channel. I'll see you in the next video.